Hey Renter Retires, it's Adam Schroeder here with another episode, joined today by Jose Berlanga. He is the CEO of Houstonian Capital, and he's also author of the new book, The Business of Homebuilding. Jose, thanks for joining me today.
Adam, thank you for having me. It's great to be here.
Yeah, absolutely. So you've been in the real estate business for a very long time. You've done many, many things inside that industry, but tell us from the beginning, what was the first deal you did? And, how did you, what kept you in the game after you did that first deal?
Well, some of the first deals that I did in real estate were a consequence of other businesses. Maybe I was a tenant, and eventually I needed the building for my operation, and we ended up buying it. So it wasn't really intentional. I got into real estate. I tell people that who want to get in this business that maybe they'll end up with, most of us are in real estate even when we don't realize it. Even if we're leasing an apartment, leasing office space or warehouse space, we're already in the real estate business. We all need to be involved one way or the other, and that's how I initially expanding my operation when I was in the exporting business and other businesses, just renting space, negotiating leases, and eventually buying a couple of these properties. So that was not an intentional attempt to get into real estate. My first real intention of getting in this business was in the residential business, in the residential construction. This was a very interesting transaction where my brother and I got into building homes. And we bought this little property in the Houston Heights, which was not a very popular neighborhood back in the 90s.
My, how times have changed.
Oh yes, it was approximately a 6,000 square foot lot that we bought for $7,500. If you can imagine that, those run $500,000 or $600,000 today. We didn't know what kind of deal we were getting, and we certainly didn't know where this neighborhood was going to end. We had a good idea that it was a new trend to start moving into the inner cities, but that's how we started, and we went into the second deal and the third, and so on and so forth, and build a company with that very small investment.
So what made you decide that it was something you're going to stay in? Did it just go well and you figured I'll just try another one, or were you like, well, this was so terrible, I have to try something to get the taste out of my mouth? Or what led you to the next investment? Kind of what kept you in real estate?
It kept the persistence of wanting to make money, because on the first or the second or the third deal, we didn't really make money. We actually lost a little money on that first cottage that we built in the Heights. In the second one and the third, we didn't really make any money. But there were two components there, the two ingredients that took place there. One was that I wasn't living off of it. It was an investment. And that helped a lot for me not to require that money in order to keep going. And the second one was that the fact that the cottage and the first couple of houses that we built sold in an area that wasn't proven, in an area where no new construction was being built at the time. We were innovating. We were pioneers. We were speculating in these inner city forgotten neighborhoods at the time. It gave me a very good sense of hope. Just the fact that the house is sold told me, well, I guess there's a business here. There's something going on. If we were able to market and sell some houses in an area where, to me, it would be difficult for investors to want to live in, or new home buyers to even want to consider. So that gave me the feel to try it again. And we tried it again. And several attempts later, all I understood was that we needed to tweak the numbers, because we were new in the business. We had never built homes before. Neither my brother or myself had any experience working for another builder, which most developers, when they go on their own, maybe they worked before at another company and had a little bit of experience to bring to the table. We were ignorant enough, gutsy enough to get into a business that we had no clue what we were doing. So I don't know if it was good or bad, but little by little we kept learning and tweaking the numbers, tweaking our costs, our structure, the finishes, the details, the way that we were operating the business. Because what we knew from day one was that there is a demand. We figured that one out. And we thought to ourselves, if there is a demand, I'm sure we can fix the other things. So we built another small development, then we built 2 homes and 4 homes and 8 homes. And soon enough, it started profiting. It started making sense, but it took several attempts. And it took having the creativity and the resources to go and find more money for the next one. Thankfully, we didn't lose a lot of money because it wasn't such a big investment in those early exercises. But it was definitely scary, and it was definitely a speculative move. But it really told me that there was an opportunity. To answer the question, that's what kept me going, that I felt that there was a business there to be had. And here's the most important part and interesting part. When we actually started making some money and you get that little taste of the profits of real estate, it's very difficult to walk away from it.
I tell people that all the time. It's addictive. It's a good addiction to have most of the time, but it's addictive.
It really is. It really is. And I have to add that once you start making a profit, it doesn't guarantee that subsequent deals are going to be profitable. No deal guarantees the success of your next deal. That's a fact. You win some, you lose some, but when you make some money in some of them, that addiction to that taste of success makes you keep trying, makes you think that I got to keep going because I already had a successful experience, which tells me that I can make money in this business. So what I'm trying to say is I don't always make money on every deal, and that's okay. You have to average them, and you have to get better averaging your deals and understand that every now and then there's going to be bad timing. There's going to be something that didn't go your way, but you just have to keep going. It wasn't a consistent success story. It had its ups and downs, and some developments didn't do well, or some did better than the others. That was a trend.
Yeah, that's phenomenal advice. As so many people hit their first speed bump, they'll get a couple deals and things are going really well, and they think, oh, I love real estate. Then they buy a property, it doesn't go like they plan, and they think, well, this real estate doesn't work. I'm out. I'm just going to sell everything. I'm done.
My first deal didn't make money. My second deal didn't make money in the actual real estate business. Once I got involved in operating a real estate company, it didn't make money, but that didn't stop us. That didn't stop it. You have to be positive. You have to understand that, like you said, it takes time. And then much later, we didn't make money in some other transactions, but again, we didn't stop. Even after bad cycles came about, you just have to stick to it and figure out. Here's another great piece of advice. When you start making money, put it away, save it. Don't start living life and don't start spending it, because it's just a matter of time before the market changes, and you will depend on those savings. You will depend on those good years. We tend to think that once we do well, it's never going to stop doing well. And that is never the case. So you're going to hit a new speed bump. You're going to hit a new economic downturn, new variables, new circumstances that will make things very difficult all of a sudden. It happens to every developer, builder, investor, and you have to be frugal during the good years just as much as the bad years.
Yeah, all the unknown unknowns, right? It's what you gotta worry about. So, as a home builder yourself, how many homes roughly have you ended up building so far?
Oh gosh, a couple of thousand homes over my entire career, which in it, considering the business model that I'm in, it's a world of homes, because the type of homes that I'm talking about, they're inner city scattered type of small developments.
That's a
2
lot.
homes, 4 homes, 6 homes, 1 over here, 12 over there. They're the logistical nightmare of operating our company was very unique, because I'm not talking about subdivisions or master plan communities that the public companies build out in the suburbs, where you can buy a few thousand lots at a time and just cookie cutter track home building. This is the type of business where just to find one location to build 2 or 3 homes, just to find and secure one site, I had to look at 20 or 30 of them and drive all over town and invest a number of hours. So for a company to build 100 or 200 homes in the inner city in a scattered manner, fashion model style, it was extremely complex, I have to say. So building the number of houses in so many neighborhoods, in so many areas of town, with so many floor plans, elevations, styles, homeowners associations, neighbors, tight spaces, dealing with encroachments, dealing with upset neighbors because you're messing up the street. And it was a very, very challenging operation. So to answer the question, it's a lot of homes for a small inner city builder.
Yeah. So now that, being in the home builder space, with what's going on right now in the home building environment, which is not many homes being built relative to what we most likely need in the country, kind of what is your expectation for what's going to happen over the next, we see it reduced now, but what about, how is this going to impact us 3, 4, 5, 10 years down the road?
Well, the country keeps growing. The need for housing continues to grow. So if you look at it long term, it's always positive to me. This industry is not going anywhere. The investment sector, the developer side, the builder side are long-term gains that are not going anywhere. We just have to understand that in the short term, there are ups and downs, there are cycles. Right now, we're going through a tough one. We're going through a difficult one. This year, we have elections. We have a difficult economic environment, political environment, a lot of uncertainty. Interest rates are very high. We are now caught with a little too much inventory in certain price points in certain neighborhoods. So yes, this is a tough year that if you're not prepared for it, it's going to catch you off guard. So this is what I was talking about. This is where you have to have some reserves, some cash, the ability to sustain your company in to pace yourself, slow down your production, have a company that has the flexibility of increasing, ramping up your production or cutting back when you need to. And that takes years of experience, of course, to have that, the ability to fluctuate the levels of production that your company can put out. And I think that things are going to change. They do. These markets are a moving target. But what I keep mentioning lately is that not all markets are difficult right now. A lot of them are. But if you're an investor, if you're a home buyer, if you're a developer, you really have to study and research your niche market. There's pockets that are doing very well. There's price points. There's neighborhoods that are doing better than others. So you have to evaluate before you make an investment, before you start a development. Look at the inventories. Look at what's coming up on the market. How much has sold in the area in the last 3 to 6, 9 months, so that you can kind of forecast whether what the business you're about to get into makes sense or not. And if there's too much on the ground, too much competition, not enough traffic, not enough consumption of this inventory, then either look for another market or wait. So we are doing that in our business. We are moving around. If certain markets are not moving as fast, then we're holding there and not starting anymore and moving to other areas of town, so on and so forth. But to answer the question, the future is always bright, even when the short term doesn't look too exciting. You just have to understand that this is a cyclical industry, period. In this year has been tough. This is every slowdown, every hiccup in our industry is caused by different ingredients. Sometimes it's actual economic issues. Sometimes it's more emotional. Sometimes it's too much production, too much inventory. Sometimes there's lack of employment, which is the number one driver in our industry. And this particular time, it was provoked. It was necessary to reduce inflation. And so you have to understand what's causing the slowdown, what is causing the fluctuation in your market, and then just work with it. So it's easier said than done. I know it's, because having work in progress costs a lot of money. Your carrying costs, your interest, your property taxes. It's not easy to hold properties and wait for the market to turn. You just have to know that if you need to sell and forget your profit and move on to the next project, you need to be emotionally ready. That is something that I'm always ready. I'm always ready to sell developments without a profit, and it's very difficult for investors to do that. Or for homeowners, if they need to sell their home and it's a bad market, you never want to sell during a downturn. But unfortunately, there are circumstances where you have no choice. You lose your job, you lose your income, and you have to sell. And you just have to understand that maybe you'll make it up on the next one and move on. So don't get caught trying to salvage a development or a property because it can drown you if you don't have the resources to support it.
Yeah. So one of the things we like to focus on are nice 3 or 4 bedroom homes, maybe 13 to 1,600 square feet. Purchase price $400,000 or lower. And when you look around at the building environment, I mean, that barely exists anymore. I mean, you're in Houston. I used to live in Houston. I drove by the house that my wife and I lived in when we first got married, which was up in the just north of 610, right there at 290, and it was 1,200 square foot cottage house, and now it's a 5,000 square foot 5-bed, 5.5 bath home, and just, I mean, they're completely redoing the neighborhood. Is there a chance? Is there a profit margin enough in there that we might see more of the affordable starter homes being built? Or is it something where if you're able to buy starter homes right now, you've got a really good product for the long haul that isn't going to be getting replaced?
Wow, there's so much to this question. Very interesting, because let's start with when I started building in the inner city of Houston. The homes that we were building back in the 90s, early 2000s were under 200,000. Okay, I think the median price was 170, 180. Then it jumped to 220. So those homes are now selling for 500,000 or 600,000, maybe plus. So somebody who bought a $200,000 home, now it's worth 600 or 700 in those same areas. Now, is there an opportunity? Absolutely, yes, but not in those same neighborhoods. The meaning of inner city has changed. What used to be a very small inner ring has gradually expanded in every city, in Austin, in Houston, in Dallas, in San Antonio, in other states. The loops, now they have outer loops. So now our meaning of inner city, we're no longer building, obviously, $200,000, $300,000, $400,000 in the immediate inner city, inner loop. But now we're going outward a little bit, which is still considered now inner city. That's where we're building the $400,000 or $500,000 homes, and that is now considered an entry level. That is an inexpensive home under today's standards. But I forecast that those houses in 10 or or 15 years are going to be $800,000. So those homes will continue to be a good opportunity. And as a matter of fact, I always recommend for home buyers to buy in difficult cycles like this one, because builders and developers are willing to offer concessions and discounts that they normally wouldn't. So if interest rates are high, you can always negotiate. You're not married to that interest rate or to your mortgage. You can always refinance, but at least you bought at a low point. I mean, we're doing that ourselves. Speaking of that price point, 350s to 500,000, we're almost selling at break even in today's market. So a buyer can probably knock off $40,000-$50,000 off of a house. And maybe by next year, when things, interest rates change and the political environment changes, they will make that equity and then some, because not only interest rates will adjust, but inventories will be lower at the time, since not very many people are starting homes. So to answer the question, yes, there is still opportunity. You just have to move to different pockets of the different areas and look for those new transitional neighborhoods. Obviously, some of the transitional neighborhoods from the 90s and early 2000s are very developed now. So they're expensive. They're very established communities. So you have to look for that new area of town that has the potential of reappraising in increasing in value at a rapid pace.
So how do you, as people go around and look for the best investment for them, as they, if they're not tied to a specific area, let's say they're not a builder, for example, and, like, I don't think you're going to be building in, Tennessee, or probably not even in Oklahoma or Louisiana or anything like that. You're going to stay in the Houston area. But as an investor, as you go and look at investments around the country, what are some of the things you look for in a market? And what are some things you look for in an actual property? Like, what metrics do you really like to use to find a good market and then to find a good property inside that market?
Great question, because that can always be deceiving. I talk about the difference between a actual economic data and emotional economic data. There are periods in time where we feel that it's a bad time to buy, but maybe it's the opposite, and vice versa. So the recommendation I give when I go into a city that I don't understand very well, or a neighborhood or a market that I don't know as well, I start looking at tangible economic information, which is components, ingredients such as how is the employment doing in that area? What is the growth? Are people migrating to that area? Are you seeing true economic growth in consumption? Another one is, how is the rental market doing? Because I, as a builder, developer, and investor, I see renters as the raw material of future homeowners. So if that market, maybe for whatever circumstances right now, people are not buying homes, but they're still moving into the area, that's a good sign. Because maybe right now they don't have the down payment, maybe right now they don't have the credit score or the ability to buy a home, but sooner or later they will. So if the rental market is growing, that will spill into new home buyers. So you have to look at real growth in economic data in your area. So there are better areas than others throughout the country. And even at if at any particular moment in time, any given moment, it's not doing very well, you're not seeing the increase in prices, it doesn't mean that there's not a good opportunity. Maybe it's actually a good opportunity to secure a piece of land, because at that moment, the market has slowed down. Maybe they produce a little too much at that. So you have to wait until that gets consumed and start again. But that's what I do. I look at what is happening economically in that area. Thankfully, there is so much information out there on the internet. You can see new corporate headquarters moving in, new employers, data as to what are the industries that are doing well, which ones are hiring, which ones are firing, so on and so forth. And the other piece of advice that I give is to look at your personal finances. You have to also consider then when you make an investment such as buying a home or even a rental property, not only look at the forecast, look at everything going on now in short term and long term, but can you sustain a worst case scenario? I think that long term real estate always does well, but what if you go into a speed bump in the economy or in your local situation? Are you able to handle your home? Can you afford it? Buy a home that you need. Buy a home that you want. Don't do it just because everybody else is buying or sell because everybody else is selling. You also need to understand what are your personal circumstances. And if you want a home, if this is something that you need and you want, sooner or later you're going to make money on it. So think of your current lifestyle. That is also an important part of making a decision.
Yeah. So as an investor, whenever you're talking to, you got a newbie investor here wanting to, thinking about getting into the game, and you've touched on this a little bit, but I want to hear the kind of the exact wording you would tell them. They say, I'm thinking about buying a rental property, but interest rates are high, prices are high, returns aren't that great right now. The cash on cash is compressed, the cap rate's down, all of that. Why on earth would I buy in a time like this? What, other than slapping them on the side of the face and saying, what are you talking about? What do you tell that person?
Well, first of all, it sometimes is about finding the right deal, and it's not that easy. Sometimes you may say, "Well, the cash on cash, the cap rate on this property is horrible. It's even upside down." Well, my initial response is, "Let's look for another one. Don't give up. Don't assume that the 2 or 3 that I looked at determine the market. There are always opportunities out there. You just some periods of time make things harder to find that opportunity because more people are looking for it. So my initial response: keep looking for the right one. Keep looking. Nothing comes easy. You don't find it in 5 minutes. Do your research. Drive around. I remember me when starting in this business. I couldn't find lots that were feasible to build. Very good analogy. I guess there's no more land there. And I'm talking about the year 1999, 2000, 2001. Imagine I was thinking that already. There's no more land. Everything's expensive. Everything's overpriced. Nothing makes a return. No, I just needed there. I would spend hours and hours, day in, day out, in evenings after dinner, weekends, driving block by block for sale by owners, looking on the multiple listing services over and over, looking at all listings that are stale, that eventually sellers didn't get the offer that they want, and months later they start considering a good one. Okay, because initially everybody's optimistic, everybody overprices things, and maybe months later they come to their senses and go, okay, I guess I'm not getting an offer. Let me reduce the price, or let me start considering low offers. But at that point, nobody's paying attention to those properties anymore. I would pay attention to listings that have been on the market for a long time. So keep looking. I used to think that even as an early new investor, there are no more opportunities out there. Well, I just needed to look harder and spend more time at it. Now, secondly, once you find one, look at a market that is up and coming. Are there other developments coming up? What does the future look like? Do I see other new construction happening nearby? Maybe not necessarily in the immediate perimeter, but close enough in coming in this direction. That's how we invested in a lot of inner city areas, because they were close enough to other developments. They were still scary. They weren't really appealing, but they were close enough to other appealing neighborhoods. And we just thought to ourselves, I guess it's coming in this direction. If we wait a few years, if we buy some of these properties and rent them, even if the cash is horrible, even if the cash on cash maybe just barely breaks even if you buy something and once you put your equity and get some leverage, it pays for property taxes and then makes a bank payment, sometimes that's enough. Don't expect every deal to give you immediate gratification or immediate cash flow, even if it just barely breaks. As a matter of fact, I bought properties, investment properties, where I was upside down on the monthly payment. This is what I talk about, your personal situation. I was able to afford a few $100s of being upside down between the rental that I was receiving, and it wasn't enough to pay for the mortgage, for property taxes, for maintenance, for unpredictable costs. I was upside down, but I saw the opportunity that eventually, soon enough, in a year or 2 years, that was an up-and-coming neighborhood where I could flip it and make my money on the back end. I made a lot of money doing that, but I knew that I had the ability to support the small amount of cash where I was upside down every month. So if you can do that, but the opportunity is there, capture it. If you cannot, then just make sure that you can at least pay the bill. You can at least make your payments with a rental income. But don't necessarily always look at something that's cash flowing above and beyond what it costs, because what you're also looking at is the appreciation of the property. In most real estate transactions, that's where your profit is. It's not really on the cash on cash. So that's what I would tell. Don't fixate yourself. Don't focus so much on how much is giving me every month right now.
Fantastic. Now, Jose, you are the CEO of Houstonian Capital. You're the author of The Business of Homebuilding. Tell us a little bit about what we're going to read in the book, and then tell us a little bit about kind of Houstonian Capital and who would be a good fit for, that company.
Yeah, well, Houstonian Capital is the parent company, is an investment company where I hold different investments from commercial to multifamily. I operate a company by the name of Onyx Residential and Onyx Land Partners, which builds homes, or I invest in building single-family homes, in build to rent, which is a new trend. Now you build homes not necessarily to sell.
Oh, we love BTR.
Yeah, we are doing some of that where we're building some communities to hold them just for rental. There are so many sectors in the industry now that I believe in and that I like. So Houstonian Capital is my company currently, but I'm involved in all. I enjoy every area of real estate, from investing and developing. Obviously, we all prefer the more passive ones if we can. The ones that are a little bit easier to manage. But ultimately, I've learned that they all require a little bit of time and effort and in patience. So, but what was the other part of the question?
What people are going to learn whenever they read The Business of Homebuilding.
The Business of Homebuilding is near and dear to me. It were many of my experiences about being in this business after I felt like I needed to start writing down some of these stories and experiences. But I have to admit that I didn't intend. One of the fun things about writing this book is that it's about much more than just building a business or getting into the real estate construction business. It's about adversity. It's about even learning how to buy a home. If you're thinking about making an investment, starting a company of any kind, not necessarily in the construction business, I talk about some of the setbacks, some of the obstacles that I went through, some of the things that I forgot to think about when I started this business. And I list them in an order where it can help you at least organize your thoughts, understand what you're getting into, make sure you don't forget to do some of the fundamental things that a business requires in order to start and in order to be built. So this helps anyone who wants, any realtor and anyone who is in other areas of real estate, even a broker who wants to enter the development side of things. This really, really helps, even to buy a home. I'm telling you, this book helps entrepreneurship in general. I really wrote it because I love telling stories. I love talking about this business, and I think that it will help people avoid some of the mistakes that I went through in a very fun and simple way. I wrote it. It's not a complicated book. It's easy to read. I believe that it's fun, and I'm enjoying it. I'm writing. Just completed a second book that hopefully will be published very soon about land development, real estate speculating, and I'm going to continue doing this. This has become part of my journey to start putting things down on paper.
Well, fantastic. So the website, it'll be in the show notes as well, but the website is joseberlanga.com. That's joseberlanga.com. Really appreciate you joining us today and giving the insight to the investors out there. You heard what he had to say. Don't just fixate on day one. I always like to say, you can look at that pro forma for year one, but don't forget there's years 2 through 30, and there's a whole lot more of those than there are just year one. So really appreciate you joining us today and giving your take on the environment. To everybody else, you can see some properties you want to buy at renttoretirement.com. That's renttoretirement.com. And don't forget, as always, if you have any questions that you want answered in future episodes, email them to podcast@renttoretirement.com. That's podcast@renttoretirement.com. Really appreciate the time you spent educating yourselves today. Talk to you on the next episode.
My pleasure. Thank you.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.